Hey everyone, it's Simon here with a mid-year market update, 2nd of July. Just thought I'd spend a few minutes having a look at where we are. It's been a little bit of time since we last did this. Not a heck of a lot has changed, but let's go through and see what the charts and what price is telling us anyway. So what we've got in front of us is a chart of the SPY, the ETF over the S&P 500 index. And as you can see, this is still trading around key mid-range levels from the February correction. So we had the all-time high here in January, the February low, and 5 months later we're still in that range, which is kind of what I was expecting was going to happen. Now, a couple of positive things to note here. The S&P 500 has held its 200-day moving average. It's tested it a few times, but it's held. The other thing that is looking positive is the fact that we are above the 50% retracement level from this correction. Now remember, if we're above 50%, we're more inclined to give the bull argument the benefit of the doubt, and if we're below 50%, that's a more bearish argument. And what's happened more recently is we've had this nice little run up from April into mid-June, and look what happened here, folks. The market slammed right into this 78.6% retracement level, which is coincident with previous highs. So it hit this support level and it sold off. Now you can blame this on Trump tweets, you can blame this on trade wars, you can blame it on whatever you like, but the fact is price was really giving us a very clear heads up that this was going to be a level worth watching and a level that the market was perhaps going to struggle to break through. We've got previous resistance, we've got a Fibonacci retracement level here. I expect that if we hold this 50% level here, the market will then go up and test this level again. And if we break through this level, if we can clear this level, then the next target is the previous high in January. Now the biggest risk in my opinion to this bull market is this chart here, which is the financials. Okay, so as you can see, here was the January high, the February correction, and we're below this level now. I mean, we actually had one close below this February low. That's bearish. Okay, we're below the 50% level. We're below the 38.2% Fibonacci retracement level, and you can see the market had 1, 2, 3 tests of this February low, and then just a couple of sessions ago, we actually got a close below that level. And if you've been watching the financials, I mean, things like Goldman Sachs just cannot catch a bid at the moment. And this, to me, is probably the biggest risk factor for the continuation of this bull market right now as I see it. However, it is not time to give up hope, because take a look at the Nasdaq. Okay, the Nasdaq cleared its January all-time high in March and then did so again in June. Okay, so we've had a little bit of a pullback. So far it is a mild pullback just to the 55-day EMA. We're still above the 38.2% retracement level, so this is just a mild pullback. The Nasdaq is performing very strongly. The Nasdaq has been leading the market. If you remember, the Nasdaq has been leading the S&P, not the other way around. What we're seeing here is a mild pullback, but we're near all-time highs, and this index is trending higher. So this is a positive sign for the overall market. The other thing that gives me hope is mid-caps. Here is the Russell 2000 ETF. You can see it tested its all-time high in March, and then back in May we cleared the all-time high just here. This was a nice little propulsion trade for me and for a few of you I know. And look, this index has continued to trend up, made new all-time highs late in June, and what we've seen here, again, it's a fairly mild pullback. We're still above the 38.2% level. We're still above historical support. This pullback could go on for a little bit longer, and it's still a strong uptrend. Now, people say financials are the lifeblood of the economy. I disagree. I think financials are the lifeblood of Wall Street, and it's really your mid caps and your small caps that are the lifeblood of Main Street. So the fact that the mid cap, small cap stocks are continuing to make new highs and showing a very strong uptrend, I think that augurs well for the continuation of this bull market as well. So let's go through and have a look at some of the sectors. Start off with XLB, which is the materials sector. Uninspiring, really a lot of choppy, flat price action for the last 5 months. I mean, this is just sideways. The fact that it's below the 38.2 level is not great. But look, let's not read too much into that, because at the end of the day, it really seems to be doing a lot of work between the 38.2 and the 61.8. So really, it tells us nothing. No trend there. Look, some material stocks have been performing quite well. BHP, Rio have certainly performed quite well, and some of the commodities are doing quite well. But looking at the sector as a whole, not much to see here, folks. The financials we've already talked about, and that's not a great looking chart. Here's another chart that doesn't look great. This is the industrial sector. So here we've got the January high, the February correction, and in May, the industrials, we got a close below the February low, and we had another close below the February low here. So really and truly, we should be redrawing these fib levels down to here. Clearly, we're below the 38.2 level. Look, sideways action, but this is not a bullish chart, folks. So be careful getting too long on industrial stocks. Okay, tech sector looks great. Okay, this looks somewhat similar to the Qs, which we saw on the Nasdaq. Strong uptrend, taken out the all-time highs once, twice. We've had a bit of a pullback here. It's still a pretty mild pullback. We've hit the 89 EMA. Those of you who follow me know that if we hold the 89, chances are we're not going to test the 200. We could well test this 38.2 level. It is a fib level, and we've got some historical support there as well. But what we're seeing there is certainly leadership by the tech sector, going through a mild pullback here. Nothing to worry about. I'm still bullish technology. XLP, consumer staples, this has just been in a downtrend really ever since that high in January. We had the pullback in February, and it's just kept finding new lows. Now we've had a fairly elongated pullback here, a counter trend move to the upside. We're now 2 standard deviations above the mean for this downtrend since early Feb, but we still haven't even got back to the 38.2 retracement level. So consumer staples still look pretty sick, and if you see any shorting opportunities in this sector, I'd be paying close attention to those right now. Real estate sector has been looking strong. We got this breakout in April, and it's just continued up in a really nice measured fashion. What we're seeing here is some good symmetry in the retracements. We're seeing higher highs and higher lows. It's cleared the 200-day moving average. The 200-day moving average is still sloping down, but this sector is looking somewhat constructive. Utility sector, not as constructive as real estate, but it has managed to clear this 38.2% retracement level and is now challenging both a downward sloping 200 MA and a 50% retracement level. If we can clear these levels, and it looks like we might, utilities could go on with it. If you do see any shorting opportunities in the utility sector, though, that is probably your higher probability bet at this point. This is going to be a fairly tough level for the sector to push through when you've got a downward sloping 200-day moving average and a pretty big fib retracement level of 50% here. So beware for this sector to potentially roll over. Healthcare sector, look, it looks pretty similar to a bunch of the others. Sideways action, not particularly bullish, not particularly encouraging. We're below the 50% retracement level. Really not much to see here, folks. Consumer discretionary looks good. Okay, this is another one of the leading sectors. Looks almost as good as tech, really. It's made new highs. We're going through a mild pullback here. It could pull back a little bit further. That wouldn't bother me. You've got to give the uptrend the benefit of the doubt in consumer discretionary. And the energy sector, that's been on fire, really. Ever since it broke out of this consolidation pattern that we were talking about a couple of months ago, it's really gone on with it. Made a new high here. We've had a pull back to the 38.2% retracement level. It's hit that level, tested it, and bounced back up. Look, a lot depends on what happens with the oil price, of course. The oil price continues to trend higher. And so long as the oil price does that, you've got to give the energy sector the benefit of the doubt. Last but not least, let's have a look at the Dow Transports. And again, just choppy sideways action, a bit like the S&P and a bit like some of the other sectors we've looked at. We've had the January high, the February low, and neither one of those levels has been tested. The 200-day moving average has been tested a couple of times. We've got a little close below here and another close below here. I don't take that as a breach just yet because the price action is looking fairly indecisive. But if we do get a big red candle below here and below this 38.2% level, that would augur badly for the transports. And the transports, I mean, it's a bit old-fashioned. I'm not a big proponent of Dow theory, but they often can act as first movers a lot of the time in what the broader market is going to do. So let's just put all of that together. All right, we've got a fairly flat, sort of fairly neutral looking S&P 500. Material sector looks pretty flat and neutral too, uninspiring. Financials look bearish. Industrials look bearish. Tech looks bullish. Consumer staples looks bearish. Real estate looks bullish. Utilities, neutral. Healthcare, neutral. Consumer discretionary, bullish. Energy, bullish. Transports, kind of neutral to bearish. So if we go through all of that, we've kind of got 4 sectors that are bullish, 4 sectors that are neutral, 3 sectors that are bearish. So it looks like a fairly evenly balanced argument. What really swings the bull case, swings into favour of the bull case in my mind, is the fact that you've got the Nasdaq in an uptrend and close to new highs, and you've got the mid caps in an uptrend and also close to new highs. US long bonds, this is the US 30-year bond, they are looking fairly bearish as well, so we could expect to see yields continue to tick up. We really need to see this level around here get taken out. Don't you love it how your resistance level is bang on a Fibonacci level? It happens so often, but if this level gets taken out, that would cause me to re-ascertain my view on bonds, but bonds look fairly bearish. The TLT as well, that looks slightly better. This is on a slightly shorter time frame. Let me just redraw that level. We're back at the 50% level, also challenging the 200-day moving average. Looks as though TLT could roll over here. That would be the higher probability play in my mind. We've had a look at oil, which continues to trend higher. Gold, on the other hand, is looking absolutely friendless. You may remember we were watching gold in this channel, looking for a breakout in either direction. And what's happened, we got the breakout to the downside. It rallied, kissed goodbye to this previous support level, which has become resistance, and it's really fallen away to the downside. Of course, the US dollar has been in a very strong bull market as well, which isn't helping gold. So not really looking at too many bullish setups on gold stocks at this juncture. Quick reminder, folks, that we will be heading into earnings season again soon. Alcoa, which is the stock that traditionally kicks off earnings season, is due to report on the 18th of July. So if you're placing trades, remember to check those earnings dates. I hope it helps. That's about all for this video update. Thanks very much and good trading.